Regardless of what you've heard about the fiscal cliff and whether we go over it, one thing is for certain, taxes are probably going to go up. Government spending will go down. We are still facing uncertainty about the nature of the economy after 2013 gets underway. My guest is Adam Moeller in Denver, Colorado. He's president of AJM Financial. Adam, great pleasure. Thanks for joining us again.
Good to talk to you, Scott.
So what is the latest news you've heard with regards to the fiscal cliff and us going over it? What's going to happen?
Well, Scott, today being Wednesday, actually 12/12/12, John Boehner said earlier today that serious differences remain with the president in talks to avert the fiscal cliff of steep tax hikes, budget cuts set for year-end. Boehner spoke with Obama Tuesday night and said the presidential proposal for $1.4 trillion in new tax revenues did not fulfill his promise for a balanced approach to taming the federal deficit. Also on Tuesday, Boehner rejected a proposal from the White House that they viewed as a concession that would shrink the amount of the deficit reduction that comes from revenue from $1.4 trillion to $1.6 trillion over 10 years. Boehner has called for $800 billion in revenue through tax reform. Scott, we're still pretty far from a deal with not a lot of time left in this calendar year.
All right, so what are the consequences then to the economy overall, and what's set to happen if nothing gets solved? If by some chance, these guys really aren't putting on this show just for our benefit to take it down to the wire, and we do go over, what's going to happen?
Well, Scott, one of the biggest risks that the retirees, pre-retirees face is that of taxes, not just paying them, but the risk that the tax policy will change and throw a wrench into someone's plans. The fiscal cliff is now staring us straight between the eyes. As advisors, we must develop a plan of action for our clients' portfolios should all or some or even none of the scheduled tax changes and spending cuts become reality January 1st of 2013. The fiscal cliff will affect retirees, pre-retirees, and the economy as a whole unless Congress acts. What we're looking at is increased taxes, higher income taxes, higher dividend taxes, and higher capital gains tax rates if the Bush-era tax cuts expire, which they're set to do so on January 1st. So, for one, marginal tax rates will rise from 10, 15, 25, 28, and 33 in 2012 to 15, 28, 31, 36, and 39.6 in 2013. Secondly, the 15% maximum long-term capital gains rate will revert to 20%, and qualified dividend rates will increase from 15% to being taxed at an individual's marginal tax rate. Thirdly, earned income tax credit, child tax credit, and the American Opportunity credits will be reduced. Itemized deductions and personal exemptions will become subject to phase out. And lastly, a big one is the estate and gift tax exemption. Now that will drop from $5.12 million to $1 million, and the top estate tax will go from 35% to 55%. So Congress still has time to take action, and everyone's individual situation will be different depending on their own circumstances. Individuals really need to consider that the fiscal cliff may just become a reality. Retirees, pre-retirees must consider how they will allocate their assets going forward in all these given scenarios. Now, I always try to prepare my clients for the worst and hope for the best, but UBS just reported that we'll see a severe double-digit loss in U.S. equities in the near future if a deal does not get done.
Right. So then lastly, in the closing minute here, talk about what you're telling your clients, because again, there's still a lot of uncertainty. We do know the taxes are going to change somewhat, but how do you help your clients when you still don't know what's essentially going to happen?
You bet, Scott. I've been telling my clients a few things. My phone's been ringing off the hook here, but first of all, normally in a down economy, investors might look for defensive stocks with a high dividend. However, with dividends taking such a significant increase in taxes, this traditional safe haven is not the answer. Another popular alternative has been CDs, but interest rates are just too low. I believe that individuals should really look at the different types of tax-deferred vehicles or tax-deferred accounts that are out there. Now, if you're working with a credible advisor, they can put you in a great product. There are great products in the marketplace today. So that's one. Secondly, harvest long-term capital gains. Individuals should rebalance their portfolios. They should be meeting with their advisors before year end. Selling assets that qualify for long-term capital gain treatment in 2012 will lock in that maximum rate of 15%. Now, lastly, like I said previously, prepare for a recession. Think about what could possibly happen in the worst-case scenario. The Congressional Budget Office has warned that failure to reduce this fiscal drag risks recession in 2013. As well, Moody's has warned the U.S. credit rating it's a risk for another downgrade. So, sorry, Scott, that I don't have better news to report for you. I will say this: I'm a positive person. I've always tried to find the good in every situation. So the one good thing, the one positive thing that we can take from this whole mess is individuals are taking the time to review and look at what they have, why they have the investments they do, and to really figure out a game plan for going forward.
All right, Adam, always a pleasure. And that, by the way, was some great information. Thank you.
Thanks a lot, Scott.
And you're watching Annuity News Now.